Hi, welcome to the Attract Capital webinar series. My name is Jane. I'm here today with CEO and founder David Barnett.
Hi, everybody.
Today our webinar title is Acquisition Finance Power Moves, How to Structure Debt for Maximum Returns. So Dave, let's start with what structuring debt means for our audience.
Structuring debt, Jane, is coming up with the right mix of loans for the transaction to support the company's strategy. In the private credit market, there's lots of different types of loans. And one of the things that you need to do is to come up with a customized structure that gives the company the right amount of money over the right time period so that they can execute whatever their growth strategy is. It could be an acquisition, it could be expansion, but it's really coming up with that debt structure, or that the other word that they use is capital stack.
Oh, wow. So what are the power moves you use for your clients?
Well, I have some themes that I use that have resulted in these power moves. And the themes that I use are, you always want to raise more money than you think you need because things take longer and they cost more. You also want to make sure that you're giving yourself more than enough time to get to the end of the growth journey. So the growth journey, everybody says it's 2 years, 3 years, 5 years. It ends up being more like 4 years, 6 years, 10 years.
Yeah.
So you want to make sure that you've got a patient lender who will not worry about getting his money back too quickly and is willing to be with you for the long term and is flexible with respect to the repayment. So you want to have more capital and you want to have more time, because the success of the deal is more directly correlated to the amount of capital that you have, not the price of the capital that you are raising. That's one of the maxims that I've learned over the last 34 years. But you definitely want to focus on longer term structures and overcapitalization. And you want to make sure that you're not overtaxing the debt service of the company so that the company can't pay its loan over the short term, because it's very hard to grow fast and to pay back a lot of debt at the same time.
Yeah, of course. So then can you tell us, what are the loan structures you use as power moves for your clients?
So I would say the biggest power move that we use, we put our shoulder into it, is we use cash flow based financing, specifically unitranche loans, sometimes mezzanine loans, but mezzanine loans are becoming a little bit dated nowadays. I'd say unitranche financings. We also like to couple unitranche financings, which are a combination of senior and subordinated debt. We like to couple them with delayed draw term loans in the form of an acquisition accordion, which sounds very musical, but at the same time, it's very helpful for companies that need continuous funding for acquisition strategies that they're working on. We have also used structured equity, which is sort of a quasi-equity form of capital, and it has a fixed liquidation preference, and it really has no dilution, and it has no current dividend, so it's very debt service efficient, and it's also very, because it doesn't have any dilution, a lot of business owners, founders who are our clients, tend to like it a lot.
That's great. So what is the best way to structure these loans?
So the best way to structure the loans is to basically look at your adjusted EBITDA. You then you use a multiple of that adjusted EBITDA. Generally, we like to look at 3.5 times of the adjusted EBITDA. And then what you do is you lock into the trailing 12-month period, and you look at the EBITDA on an adjusted basis over that period, and you put a 3.5 multiple on it. And then you would reduce any existing loans that you need to refinance as part of that overall financing transaction. That's how you do it mechanically, arithmetically, but then you also want to weigh the capital intensity of the business, you want to weigh the amount of financial flexibility that the company needs, and you also want to look at the risk profile and the strategic considerations that the owner might have. Like he might or she might think that they need to move much quicker and they're willing to take more risk and pay back loans faster, or they might be willing to wait a little bit of time before they really acquire in rapid fashion. So there's company specific as well as liquidity specific situations that you want to weigh into this formula.
Wow, that's fantastic. Thank you.
You're welcome, Jane.
Well, there you have it. Thank you for joining us. We look forward to seeing you at the next Attract Capital webinar series.